Let's talk a little M&A when it comes to private equity, because Donald Trump's return to the White House is predicted to seed the ground for more big ticket mergers and acquisitions. And dealmakers expect new appointees at federal agencies under Trump to bring a friendlier approach to M&A. We've heard a lot about that over the last month. The outlook for private equity and other deal making in 2025 is the focus of this week's CFO Briefing newsletter. We've got with us Nina Trentman, senior editor at Bloomberg News. She joins us along with Dorothy Walter, partner and CFO at the private equity firm Alpine Investors. Nina's here in the studio, Dorothy out there in San Francisco. You can sign up for the Bloomberg CFO Briefing newsletter at bloomberg.com/CFO Briefing. Nina, I do want to start with you and just get an idea from you how your sources have been thinking about the shift that we could see, that they could see come January 2025 under the new administration.
Yeah, thank you very much. It was certainly interesting to see in conversations this week, including with Dorothy, but also with other CFOs, to see that people, I think overall, are more optimistic for deal making, but they're not necessarily sort of expecting all hell to break loose. So I think the expectation is, yes, more deal making, potentially helped by lower interest rates, potentially also helped by less regulatory scrutiny that we might be seeing under the new administration. So I think an improvement from this year, and I guess we'll see where that leads us.
I mean, this year was pretty dry when we think about M&A. I mean, people have really been waiting for us to see the floodgates open and see some activity happen. As you're speaking to sources, what is the prediction? Is it going to be a slow run up into 2025?
Yeah, I spoke to Ernst & Young this week, and they were saying specifically on the private equity front that we should see sort of here in the US about 440 deals, which would be an improvement of about 15-16% over this year's levels. Interesting, I thought, was this, that they pointed out, well, the US is a bit of a leading indicator with regards to M&A. So if you see more deals here and more deals not just being announced, but actually being completed, that could also then lead to some more enthusiasm around the world. And I'm sure, Dorothy, that you can tell us more on this.
Yeah, I want to bring in Dorothy Walter, partner and CFO at the private equity firm Alpine Investors out there in San Francisco. How are you thinking about this change at the top when it comes to the top of the ticket, and thinking about another Trump administration? Because for the last few years, a lot of the folks we've talked to when it comes to M&A, they've essentially said it's the higher rates that have sort of put a damper on it. I'm wondering what you're thinking for 2025. Is it going to be rates, or is it going to be regulatory issues?
I think it's a combination of both, and nice to be here with you all. We've heard all the dire news, all the 30% count of deals down year over year in the United States. It's looking bad, but then there's so many bright spots as well, right? Transactions and $10 billion of value and more are up year over year. Average deal size is up year over year. Mega cap sponsors are very active in the market, which we're certainly keeping a pulse on those deals. 25 of them happening year to date. And on the IPO side, we have some bright spots on the horizon. HG just announced potentially thinking about taking Visma public after holding that company for a super long time. And so we're pretty optimistic. We think some bright horizons are coming.
Dorothy, talk to us a little bit about Alpine, sort of the investments that you're looking for. I know that you've been pretty active on the deal making front this year already. Talk to us a little bit about that.
Yeah, that's right. I mean, while those stats overall for the United States deal making are down year over year, Alpine's been up year over year. We've closed over 160 deals this year and coming. And the reason is we just hunt in a different pool than other sponsors. We don't let the game define us. We define the game we want to play. For our platform deals, we transition management 100% of the time, which means that we can look in different pools. Over 80% of our deals over the past 5 years have been proprietarily sourced. And that allows us to really try and set a different tone for the market.
Dorothy, are there any sectors or industries in particular that people are thinking are more primed, more fertile ground for some transaction activity as we head into next year?
Certainly industrial, certainly tech. I mean, with where the elections are going and some of those headlines, those are pretty hot right now. It's yet to be seen, where regulatory changes are going to take us. Like, are Vivek and Elon going to be effective at their Department of Governmental Efficiency efforts? Who knows? And then with those efforts, how is that going to impact different sectors that might become hot or not hot, for example?
I think one thing, of course, will be interesting to watch also, Dorothy, and maybe you can comment on that, is this: how do deal makers think about the environment for deals, not just on the regulatory side, but also what will the market confidence look like? Because, of course, some of the deals will also happen if the environment looks good and if there's a positive sentiment around that. Talk to us a little bit about that.
Yeah, I think that, like, sentiment does play a lot into it. I mean, we've been through a lot in headlines over the past 2 years with various wars and macro uncertainty. And so while I don't necessarily think that will all be resolved, we think that the increased investments by this new administration are going to really allow us to have more confidence in general support in the US for business sentiment overall.
What does the landscape look like for opportunities? Like, when you look out there to see companies that you think look like ones that you'd actually add to your portfolio, what are the characteristics that they have?
A lot of them are recession resistant. So
Okay.
we really look at, the top line trends over time, make sure that that's very strong. As I said, if we're replacing management, we're often we're cultivating relationships with these company founders over many years, right? And so understanding what it is that they've been through to build that company, where they think the future of that company is, and then making sure, again, that that top line is strong enough to withstand a management transition, and that also those customer relationships are strong enough, right? And so I think we think a lot about those pieces. We also think about fragmented, deep markets where M&A can play a big piece. And so one of the things, we've been talking about M&A volumes. I mean, let's look at the lower end of the market. There's still a lot of smaller deals trading in 5-10 million EBITDA space that can supplement a strategy for a company. They can build out different product lines. They can build out greenfielding new geographies, right? And so those are some of the aspects that we look at that make deals attractive for us, and where Alpine can bring its value creation playbook to play, whether that's on M&A, whether that's on various other value creation levers we bring.
So how are private equity firms thinking about potential M&A transactions in 2025 if the Federal Reserve doesn't cut as much as people are expecting?
It's been interesting for us just looking at the dynamics in private credit markets. So looking at, for example, BlackRock's recent acquisition of HPS and how that's creating this really imbalance in demand and supply and the provision of credit. And so while rates are certainly one thing, the availability of debt is another thing that we should be really talking about. Alpine looks at things such as like RDDTL loan terms, EBITDA definitions, those types of things to gain competitiveness in the market. And really for strong top quality assets, we're seeing quite a lot of demand out there and very little supply. And so what that means is continued ability to make deals where you have some of those compelling characteristics that I just shared.
Dorothy, we'll have to wrap up shortly, but just talk to us 1 second about valuations. Have those come down?
You can't say with broad strokes. There are certain industries that have certainly been very impacted, whether it's by governmental regulation, whether it's by other macro headwinds. I think, and then there's others that have benefited and that have seen, been able to ride through COVID and continue that wave. And so I would say valuations, you really have to poke at them, and you have to know when you're talking to your sponsors that you've invested with, like, how are they approaching those? Because some of those public market benchmarks are pretty old by now, and so we're waiting for a public market to open up again to start to establish some new benchmarks for us.
Dorothy Walter, partner and CFO at the private equity firm Alpine Investors out there in San Francisco, along with Nina Tretman, senior editor at Bloomberg News. She writes the CFO Briefing newsletter. Sign up for it now. Just head on over to bloomberg.com/CFO Briefing.